Hi, everyone. Welcome to another session of the Wealth Brief. That's where Charlie and I sit down here and give you some simple advice on how to elevate your financial future. So we get a lot of questions on how should I be investing my money? Which investments should I be buying? The market's really volatile right now. What should we be doing? What I think might be a better question, and what's even more important, is where should I be putting my money? And we call them tax buckets, but where should I be allocating my assets to make sure that I'm paying the least amount of taxes today and in the future? And Charlie's gonna try to demystify what I just said and put in English language for everyone. So Charlie, what am I talking about here?
Yeah, absolutely. Thanks, Dave. So what you're speaking to is the question of asset allocation, right? Should I be invested in a 60-40 portfolio, right? 60% equities, 40% fixed income. Should I be more aggressive? Should I be less aggressive? And again, as you can see here, title at the top, asset allocation. But as you pointed out, just as important is really this notion of asset location, right? So this is what we really dive into when we start on investment analysis for clients. So we break asset location down into three buckets. And the first one here, bear with me on my handwriting skills here, is what we call tax me now. So what is tax me now? So tax me now is, generally speaking, bank accounts, CDs, money markets, um, as well as brokerage accounts. So again, hopefully you can read that. The bottom bullet point there is brokerage accounts. So how we break this down is any interest earned in any of these accounts. So take your bank account, anything that's probably not earning much in checking, maybe your savings account, you're earning a percentage of interest that the bank is going to give you year to year. Every single year, any interest in bank account and a CD and your brokerage account is going to generate what's called a 1099. So that's income, taxable income that's added to your ordinary income at the end of the year. So how this is taxed is going to be ordinary income. So this is essentially added to your salary, right? So a large piece of this is going to be bank accounts. And again, you might have some money in brokerage accounts. It's important to be efficient in terms of those positions in that account.
Right. So I guess if I earn interest on my bank account or my CDs, I have to pay taxes on that, just like I'm making an additional salary. But in my investment account, if I'm not selling anything, do I have to pay taxes on that?
Potentially you do, and this is a common mistake, is you don't review the positions in your brokerage account. You know, the account's growing, everything's going well, so you don't need to make any changes. That might be okay, but I would certainly encourage you to review the positions and review what you're generating in that 1099 income. This should be displayed on your 1040 as well. Because even if, let's say you have a position, Exxon or Chevron, or even a mutual fund that is shooting out dividends to you, whether or not you reinvest that or not, it doesn't matter. You're still going to get taxed in that year. So it's important to understand, okay, if I don't need income off of my brokerage account, maybe it's better to be shifted into more of an accumulation growth style account. ETFs tend to be a little bit more tax friendly than the mutual funds. So this is something to keep in mind. One of the benefits of the Tax Me Now accounts are that they are liquid. It's the most liquid out of the other two buckets of money. But you also need to understand that if you're just sitting with a lot of cash in your bank account, or you have money in CDs or brokerage accounts, and you don't need that money, you may consider looking at a couple of the other buckets here, which leads me to the second one, which is what we refer to as the tax me later bucket, right? So these are going to be your retirement accounts. So 401k, 403b, again, bear with me on this handwriting, and IRAs are probably the most common examples of the tax me later bucket. So when you think about these accounts, this is the kicking the can down the road in terms of taxes. So you're not going to generate any taxable income year to year in these accounts. So if you just started at a new job, you just started your 401k plan, you're invested, accounts growing, you don't have to worry about any taxes anytime soon, right? Until you go to take income off these accounts. So if you wait until retirement and take these accounts, that is when you will be taxed on the other side. These accounts are also going to be generating income at your ordinary income rate.
Got it. So I can get the tax deduction today, but I don't have to worry about to wait down the road for to get taxed on them. So it sounds like a pretty good deal. Like, why wouldn't I want to have a lot of money in this? Because I'm making a good salary. I don't lower my income as much as possible. In the future, I'm not going to be making that much money when I'm going to retire. So what's it matter?
Sure, and that's a way a lot of people view these accounts. And the benefit, as you mentioned, is that, okay, from a year to year standpoint, you can deduct what you're putting into your pre-tax 401k. So if you max out 23,500 this year, that's 23,500 you just deducted off of your income, your salary for the year, which is fantastic. However, if we continue to do that year in, year out, and we build, and majority of our nest egg is in this tax me later account, what you're going to find out is in retirement, you're going to incur what we refer to as a tax bomb. In other words, all of our retirement has been pre-tax. So now it's time to pay the government. So 100% of those accounts are going to be taxed, which again, taxed at your ordinary income rate here. So that may shoot you up into another tax bracket. So in order to provide a little bit more flexibility, we don't want we don't want all of our dollars in the tax me later account. You benefit now, but again, if you're doing future tax planning and you're doing it appropriately, you want to diversify your tax liability in retirement. So how do we do that, right? So to this point, we've got tax me now and tax me later. So let's move on to our last but not least here. We refer to as the tax me never again. So
Sounds great.
sounds excellent, right? So Roth, if you can read that, that's a common one. 529 plans, HSAs, municipal bonds. So any interest generated in these accounts, if held properly and invested properly, are going to generate tax-free. In other words, when you take dollars off these accounts, completely tax-free, as opposed to the other two accounts. So I mean, when you think about it, it's one of the better accounts to have, right? If everybody could put their dollars into these accounts, why wouldn't you do that, right? That's a common question that we get. The first problem you're going to run into is the Roth side of things. So from an income standpoint, IRS doesn't allow folks who make above a certain income level to directly open up a Roth IRA. There are ways around that, which we can speak to, if you wanted to schedule a one-on-one session with us. But in addition to that, through your employer plan, most plans now offer Roth 401ks, 403bs, et cetera. So it's always good to consider balancing your 401k, as an example, between traditional and Roth. It's the question though becomes like how much do we weigh between those balances? But again, in addition to that, health savings accounts, 529 plans, those are accounts that are going to grow tax-free and come out tax-free.
Awesome. So it sounds to me like I want all my money in this tax never again category, but it's probably tough to do that because I'm gonna pay a lot of taxes to make that work. So what is that ratio? Like how much money should I have in tax now? How much should be in tax later? What should be in tax never? What's the golden rule there?
Yeah, that's typically the next question we get. And unfortunately, it's always going to depend on your situation, right? Your current taxes, your age, your time horizon. So when you need these dollars. So again, if you want a specific answer, reach out to us. Feel free to give us a call and we can schedule a time to go through these with you. But unfortunately, there's not a blanket answer for us that we can give you here today.
That's fair. Sounds great. Well, thanks for joining us today. We look forward to speaking with you in the future. Any questions you have, any concerns you have about your tax location or your asset location where your money is landing right now, feel free to reach out to us. We'll give you an analysis to say, here's what's going to look like today. what your taxes will look like in 5 years from now, and even by the time you retire. It's a very important thing to look at. Reach out to us at platinumpointfin.com or give us a call. Thank you.